What's up, everyone? It's Caddy with MoneyVest. So today we are going to be talking about PayCom, ticker symbol PAYC, and the stock is absolutely having its worst day in a long time, collapsing over 37% pre-market right now. I'm going to break down everything you need to know about this company and whether it's going to make sense for me to basically be buying at these levels or if there's better opportunities to look for. So hope you guys enjoy this video and find it helpful. If you do, make sure that you drop a like. Don't forget to subscribe to the channel. Again, links to our Discord and Patreon is going to be down below. If you're interested in joining, the first week of the month is the best time to join. I'm finalizing the intrinsic value spreadsheet for all the members, and that's going to be available later this week for everyone to download or basically view on the web, and it's going to be available with the price, the market price, and the intrinsic value and the difference between that. So it's going to be like a MoneyVest fair value that's going to be available so you can make better decisions. Of course, do your own due diligence and analysis on top of that research part as well. So again, link's going to be down below if you're interested in joining. This right here is PayCom, and obviously collapsing a little bit over. So if you come down, PAYC is going to be that ticker symbol. We are down over 36% for this stock right now, $155. This actually has been one of the best performing stocks. For those of you who don't know, it does offer a lot of packaged software services for payroll for a lot of these companies that they want to use their dashboard to run the payroll services. And this right here is the overall increase of 4,700%, right? So it is engaging in the provision of cloud-based human capital management, or HCM, software solutions, and delivered as a software as a service functionality of data analytics that businesses need to manage the complete employment lifecycle from recruitment to retirement. And its solution includes talent acquisition, time and labor management, payroll talent management, human and resource management. So pretty much an HR software for handling all employees from recruitment all the way till the end of their retirement. So manages everything, right? Now this does show us a little bit, it kind of gleans into a little bit more about how the labor market's doing, right? We know that labor market's been extremely tight. It's been very, very strong. But of course, it can be very company specific as well. And it can also give us insights into the global sort of, macro level of how businesses are doing with payroll. Because if they are cutting their guidance, there's possibility that, okay, there's competition that's kind of taking some of the share from PayCom, but at the same time, it could also mean that, okay, the economy is starting to weaken a little bit and the labor market's now starting to show signs of some softening, right? So there's two angles on how you can look at their guidance moving forward. But I do believe that it is kind of the latter, not the former, because PayCom has been around for a very long time, and they've got significant amount of dominance and market share in this space. So I do believe that this is early signs of the economy starting to soften from a labor standpoint, and we'll get the unemployment numbers on Friday. But if you take a look at the numbers, so the company expects $420 to $425 million in revenue for the fourth quarter. Analysts were modeling in $452 million, so about a 27 million cut on revenue expected versus consensus, and thereby the stock's down 36%. And this is exactly valuation compression, right? This is exactly one of the risks that I mentioned for high growth companies that go through this multiple compression, which is very, very important, right? Because one small miss, one small, growth slowdown can take the stock down 20, 30, 40%. That's the challenge of growth stocks, is that they've got a huge amount of gap down risk that we are witnessing with PayCom, right? They also anticipate earnings before adjusted for interest, taxes, depreciation to be about $169 to $174 million, and analysts were expecting $189 million. And PayCom also expects 10 to 12% in revenue growth in 2024. So that's still pretty reasonable growth here. However, it's a big cut, right? Analysts were modeling in 21%. So that's literally a 50% cut in the forecasted revenue growth in 2024. And for the third quarter, PayCom delivered net income of $75 million or $1.30 per share, compared to $52 million or 90 cents per share. So it's about a 40% increase on a year-over-year basis, which is not bad. And in the year earlier, the company notched adjusted earnings per share of $1.77, also ahead of the consensus expectation of $1.61. So we got a beat on EPS, and revenue clocked in at $406 million, above the $334 same time last year, and the consensus was $411 million. So miss on revenue, beat on EPS, and a significant cut on the guidance, and which is why the stock is selling off pretty significantly here. These are, again, all the numbers that I just went over. But if you take a look at on an absolute basis, the company still grew. The company still grew on a year-over-year basis, right? But just because they came in shy of analyst forecasts on revenue and future guidance is why we're seeing a significant sell-off. So these are all the outlook for the company. So adjusted EBITDA between 712, 717 million, total revenues of $1.679 billion to $1.68 billion, and total revenue in the range of 420 to 425 for the third quarter, and this is for the entire year for the company as well. Now, balance sheet is again phenomenal for this company. You'd assume like it's a packaged software, right? So it is going to be very good, and it is. So if you take a look at cash and cash equivalents, we're sitting at $484 million in cash and marketable securities, and the long-term debt's going to be right over there. Sitting at just about $29 million, and not to mention their total liabilities are $2.3 billion, and their total long-term liabilities are $3.6 billion at the moment. So that's where we are, and this is really just client funds obligation of $1.9 billion. So these are basically clients' funds that they have on the balance sheet, which they have also accounted for on the asset side, funds held for clients of $1.9 billion, right? So that basically cancels each other out. And if you disregard that, so 2.4 minus 1.9, we are looking at about $500 million. $500 million in total liabilities, including long-term debt. And they've got well over $484 million in cash and marketable securities. So they've got almost as much cash to pay down all their long-term liabilities and debt. That's actually pretty good. So we've got a pretty solid balance sheet right now. And if you take a look at the historical numbers, a very nice consistent growth. So revenues, from 107 million to over 1.5 billion. I mean, just take a look at these histograms, right? Absolutely phenomenal and consistent growth. And gross profits gone from just under 90 million to over 1.35 billion dollars. And we've got net income, it's gone from $70 million to over 281 million. Very nice consistent growth. And diluted shares outstanding have been more or less flat at around 58.6, 58.2, 58.3. Like it's just been in and around those levels. This right here are margins. So excellent margins. I mean, 87% gross margins. We're looking at, a 20% net income margins. That can certainly improve considering that they've got 87% gross margins and 20% net margins, which basically means they're spending a lot of money on operating expenses, right? So that can certainly get better over time. And free cash flow margins of 22.2%, with return on equity, capital, and assets also phenomenal for the business as well. And net income per employee has also grown from $45,000 to just under $50,000. Now, valuation was a concern. Okay, so valuation was certainly a bit of a problem. So 32, 34, 45 times earnings multiple with a price to sales of just over 8 to 9, and price to cash flow sitting at just over 31, 32. So those were definitely a bit more concerning numbers from a valuation standpoint, which is why the stock now is going to be trading at about 67% of these numbers. In other words, a third lower than where it was yesterday. Now, considering all of these things, right? So we've got the numbers on the future revenues, 1.679 to 1.684. So let's just, take $1.68 billion of revenue and cash flow margins of about 22%. So we're going to do 1.68 times 22%. We're looking at $370 million in free cash flow for the business. So if you come over to the discounted cash flow, and we're going to type in PAYC, and we're looking at $370 million in free cash flow for 2023 is what we're assuming. We hit enter. Growth rates obviously is not going to be that high, so we're going to have to go a little bit lower. So let's just do 14% here. Discount rate is going to stay the same. Terminal growth rate is going to be 3%. Margin of safety 10%, and we're looking at just under $100 per share for the intrinsic value, and it's going to open at around 150, right? So 156 is where the price is. So 37, right? So almost 40% more potential. In other words, it's down 37%. It needs to go down another 37% in order for the stock, at least in my opinion, to be trading at its intrinsic value based on a discounted cash flow. Now, let's just do the reverse discounted cash flow, right? Since it is trading at around 156 right now, let's just see how we can bring that number up to 156 and what does the company need to do in order to be justified at today's intrinsic value. So let's just say that it grows at 20%. Still not there yet. Let's just say it grows at 25. Not there yet. Let's just say that it grows at 27. There we go. So 27% is going to put us at 158, 159 for PayCom, which I believe is not going to happen. I don't think personally that PayCom is going to be able to grow at 27% free cash flows over the next 5 years. It is possible, but it is a low probability scenario for the company. So that, of course, is going to definitely, in my opinion, not still be justifiable at trading at 156 at the moment. So it definitely does need to, come down a little bit more in order for it to be trading at its intrinsic value. In other words, sub $100 is really what I would be looking for the company. So, we're now potentially going to open below the COVID low. This is a support at 161. We'll see if you actually do trade back above that level or not. This right here is going to be another support level at close to $112. And I do have some flexibility range. So in other words, it doesn't have to precisely come down to $97, but sub $100 is where I could see myself kind of starting to do more research and some more analysis into this company to better understand, okay, is it worth spending more time on? Is it worth buying at those prices? But that's where we are with PayCom. So even a 36-37% drop from a free cash flow perspective only makes sense if you believe that the free cash flows are going to grow at over 27-28% over the next 5 years, which I don't believe is going to be the case for PayCom. It's very difficult. I mean, it's quite difficult to grow at 27% over the next 5 years in terms of free cash flow. So it's possible, yes, but it is very low probability. So I hope you guys enjoyed this video and a complete update on this company. Let me know your thoughts down in the comment section below. As always, if you enjoyed it, found it helpful, make sure that you drop a like, subscribe to the channel, and of course, link to our Discord and Patreon is going to be down below. And as always, happy investing, and I'll see you all in the next video.